Hey guys, welcome back. Today we're going to be diving deep, like just computer, motherboard, and all the internals of Intel to see if it's a good buy or not. Some analysts say that it's undervalued right now and that it's really low price and we should get into position of it. Is it just all hype, or is there some reasoning behind why Intel all of a sudden is coming back into the market like a powerhouse? Stay with me on this one. Alright, so here's the article from Barron's. It says Intel has a new data center chip and Credit Suisse says the stock is a steal, meaning that it's worth a buy because of this low price. But one thing I wanted to point out is that yes, it may be a good buy based on the information provided here in the stock ticker. We have the PE ratio below 20, which is at 13.46. The fair value of it is in the middle, is not overpriced. The forward and dividend yield is fairly decent at 2.10%, and everything fits this criteria of short, mid, and long term. I mean, Intel has been around for a very long time. It has a reputation of having good products, especially jet chips, right? So let's go into further detail of this chart. But what I did find interesting with this chart was that way back in 2000 and actually 1999 all the way up to maybe the 2000 when it actually fell apart just like everything else in the technology industry. We're not going to go into the whole, internet boom or whatever, but 1999 at the peak of what Intel was worth is literally what we're hitting at today. 11 years later, the stock of Intel is finally reaching back what it was in 1999, which I found really interesting because you could see in between that time, it has gone really, really low. In 2008, well, because of certain situations that affected the economy, I don't blame 2008 as being the lowest. Intel in general has not kept its pace of growing at a steady pace. And I could find probably a reason behind all that and why technology stocks such as Intel is so hard to maintain itself throughout, the course of all these years or entire decade from this example. So here is my balance sheet. Now, this is what I use to figure out if I want to get into a position of a stock or the company. And I would use this to see if it's financially stable. And at the same time, if I was to buy it based on these numbers, if the intrinsic value is the right amount for me to get into it. Let's start off with the intrinsic value. The ticker of Intel is INTC. Okay, it's at $66.56. Right now, this is actually pulling live feeds from Google Finance. Okay, now the intrinsic value of this, now these are formulas that I've had pre-populated with the blue cells you can see here. And this is the formula that Ben Graham, Warren Buffett's mentor, the numbers that he used to fix values. And the formula that I'm using in here are based on another Excel spreadsheet that I put together in another video. And I'll link all that in the description and maybe I'll tag it somewhere up here as well. So the intrinsic value, what all this information, and these are the information that I pulled from the ticker itself, 5-year growth as well, and the EPS is current as of today in 2021 of April. One thing that I didn't readjust is the bond yield, which the bond yield is as of April 6th is 2.92. So now we have to come back in here and change this 2.92 and see if it's still a good buy. 2.92. The intrinsic value to $92.53. The current price is $66.56. So what's the problem? It's considered a buy. Upside is 39%. Dividend is 1.39 and the yield is 2.10. Just basically on this intrinsic formula, it's Intel should be a buy and there's no questions about it, right? Well, there are other little factors that may contribute to your decision on buying Intel or not. And I'll bring up throughout the course of this video. But stay with me for the last one because the last one's really critical in making your decision on buying this. Now, $66.56, good dividend. I would put some money into it. And here are some of the reasons why I would put some money into it. Now, the trailing 12 months all the way to 2017. This is all information based on the Yahoo Finance page of the ticker that's available right here. So I can pull up the analysis. 5-year forecast is 5.43. Previous 5-year was 19.01. Current year is negative 13.40. Have to figure out why this year is a negative, but all the other years before and after us is in the positive. Well, that also explains why the future 5 years would be in a positive 5 since the previous 5 has been at 19. So you kind of take the difference of the two, and this is where our difference is as of today, right? So as of now, Intel is in the negative, and we'll leave that alone for now. Gross margin, being that I don't want to be a hardcore stock analysis, I also want to educate people. Gross margin. I'll have the definition of gross margin. why the growth margin, anything above 40 is good. So the gross margin means is a company's net sales revenue minus its cost of goods sold. In other words, it is the sales revenue a company retains after including the direct costs associated with producing the goods it sells, okay, and the services that it provides. So that's the definition of gross margin. Anything above 40% is green, as I have it here. And of course, all the years it has, been pretty consistent on being above 40%. And you can see their income, the net income, their revenue, and their gross profit has been okay. It's been very steady through the last 1, 2, 3, 4, and trailing 12 months. You can say up to 5 years. But what about the net margin? Net margin is the percentage of revenue remaining after all operating expenses. Operating expenses like the lights, electricity, utilities, and then the cost of paying people, vendors and all the other good stuff to make this particular product. All right. So that's the final what Intel pockets into as their money that they made at the end of the day. So that becomes at 26.84. And I say anything above 20%. Oh, and I don't know why conditional formatting formula is off. Oh, I did it wrong. Sorry, guys. So what I'm going to do here is anything above 20% is done, is good, and anything less than 19.99% bad. We can see here so far their income statement is pristine. 2017 a little off, but not horrible. Gross margin and net margin. This is everything that they pocket after the fact of producing, selling, cost, revenue, vendors, blah, 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 everything. All right, so the gross margin is everything that after they make the product and they sell it, and that's what they made. So the income statement looks pretty good. Intel so far has been 2 out of 2. Intrinsic value is good. Income statement is good. So let's look at their balance sheet now. Balance sheet, I said anything here, anything above 20% is efficient. That means anything here is that they're making to the dollar, they're gaining equity, they're generating income, their return on the money that they're spending or putting into the company. So anything above 20, so just imagine that they're making 25.79% in 2020, whatever dollar in they invest, they're making back 25.79% on that. So it's money that they're reinvesting into the company and they're getting a return on it. So I said anything here in 20% is really good or efficient, because let's just imagine, for example, you put $100 into your savings or your checking account and you're getting close to 1%. That's 1% return. Stock market, S&P 500, you get, maybe I'll just give a broad example of that. Maybe you get a 10% return. But here, Intel's reinvestment of money that they're putting into the company is getting a 25. In 2019, they got 27, and 2018, they got a 28% return. 2017 has been a bad year, and I noticed this trend that across other companies I've looked at, 2017, there's something a little fishy that happened around there, but I'm not going to get into that. But just know that as each year goes on and forward, they are doing pretty well. So right now, they're 3 out of 3. Intrinsic value, income statement, and balance sheet. What about their cash flow? Cash flow seems to be a little issue here. Cash flow means they are, what money they're pulling in consistently, and so far the less the better I have here. And you can see they're hitting extreme high numbers that are nothing even close to being less than better. Less will be equal to 0, meaning anything closer to 0 is better, that you're not in a negative cash flow. So this is pretty much their expenses, and this is the net incomes. Ratio wise, it's and here's the formula for it. So it's B23, which is your capital expenditure divided by your net income, and you get your percentage, and it's a negative 69%. And that's why all these are red. Okay, so that's the cash flow. All right, so they're not perfect in all aspects. So they got 1, 2, 3, 4. They got 3 out of the 4. So what's the problem? What is the problem? Here's a couple of things I wanted to point out. Here's a dividend payback. Not bad. I mean, it's been consistent. It hasn't been horrible. The other thing is, this is their research and development. They do spend a lot of research and development. So take 1 and 1 together. You have your research and development that you spend a lot of money on, and you constantly have to stay in the market to be in existence in this industry of technology. You constantly, right? So just think about how all the Intel chips throughout all the years up until now, how much they've advanced, right? That requires a lot of funding and money to put into this. It's not like Coca-Cola, like Warren Buffett would say, that there is no research and development. It's a formula that they had, and it's constant. Maybe marketing, yes, advertisement, but Intel would require all of that. Marketing, advertisement, research and development, a whole team, full-blown, like, research facility to accommodate all this, right? As times change, you can't be stuck with old technology. So that's one of the things that you may come into factor. So sorry, my camera light just died, so I had to use a secondary light. So okay, now we have other considerations that we may want to look into. I want to point out that Intel's debt is really high. It's at $29.61 billion that it currently sits on, that it owes. It's from $38.35 billion with $36.09 billion in long-term debt, which is majority of it, $2.25 billion in current debt, which is as of this year or in 2020, adjusted for $8.74 billion cash equivalent, meaning anything they could liquidate that they can get money instantly to pay off a portion of this debt, is the $8.74 billion. So that leaves them with a total debt of $29.61 billion. That is high, considering that they say they have a long-term debt of $36 billion. It's a very, very big number to carry on for so long. You don't know what the interest is. It may be variable, it may be fixed, or whatever the case is. It's a debt that they need to carry on throughout their existence of the company so far. Now, if you want to take that in consideration, one thing Warren Buffett says is if it carries a long-term debt and then it can't pay off based on what it has or what it can generate in revenue in the next maybe 5 years, you have to be cautious of a company like that, because they can just, one bad incident can lead to horrific fallout of the company. It's very, very unstable at this point, because, and that's my opinion, if I was to put money into Intel, yeah, it's great that they come out with new products and they're trying to achieve this new jump ahead again, even after 10, 11 years of hitting its peak back then. But there are competitions that they're going against right now, and that one competition is right here. It's AMD. They are also in that same industry. One thing I wanted to point out was Apple products, and this is from my reasoning, Apple products have switched over to their own proprietary chips. They moved out of Intel. That may or may not affect your decision on investing in Intel, but you have to relate one plus another, meaning just because on the news or in the media that people are saying, oh, Intel's a good buy, you do some value work and you come up with, oh, Intel is a good buy, but there's some hidden things in there, like why is it getting hyped now? It possibly can be that, they came out with some new technology and whatever, but at the same time, they have a huge debt. They lost one of the biggest vendor, which is Apple. And this is not something recent for Apple chips to switch over. It's been some time already. New products of Apple are not carrying Intel chips anymore. So you have to be cautious of that. That kind of information is very critical when you're thinking, if you're going to invest in Intel, thinking that, Intel still has Apple or it has other manufacturings that is pushing chips to. So in my opinion, Intel, because of those factors of debt and lose Apple as a supplying to, I would not put too much into Intel, considering that some of these analysts are saying that Intel is a good buy right now. I would probably take a step back, let it sit for a while, because in 11 years, if you had invested back in 1999 at its peak till now, you just basically broke even from then to now in 11 years. So it's a tricky game with Intel, depending on how much you want to speculate on Intel. But the company is a strong company. Unfortunately, I don't see it as a profitable company, even though it has history to it. I want to thank you guys again for being here. I hope you guys appreciate this video and my insight on Intel. I want to thank you guys for being here. Bye.